Levi is an apparel company. Obviously, they design, market, and sell jeans, casual dress pants, tops, shorts, shirts, jackets, all kinds of stuff jean related. They sell them here in the United States as well as Europe and Asia. It licensed the products under Levi and the Dockers brands. That was actually an interesting tidbit I did not know. Levi also sells through third-party retailers such as department stores, specialty retailers, along with franchise and company-owned stores. They have 3,100, stores worldwide, and it was founded in 1853. So they've been around for a little bit. They were founded in San Francisco, California. This is an interesting little tidbit you can impress your friends with. They started during the gold rush as a means of clothing for miners because Levi jeans were very tough and the miners could wear them on a consistent basis without ripping up their clothes. So how does Levi make money? Well, they make money through selling their stuff through wholesale, which is about 64% of their sales currently, which is through the department stores and retailers, as well as direct to consumer. So that is about 36% of their company sales, which comes through the company-owned stores and e-commerce. E-commerce is a big growing part of their business now. It's actually grown up to 23% of their net revenues. They reported a record gross margin for the quarter, 58.8%. Their operating margins were 8.3%, which were within historic norms. Debt. The company has taken on a little bit of debt, but it's still within reasonable levels. Their debt to equity right now is 1.65, and their interest coverage, which is actually really good, is 6.12%. Free cash flow, one of my favorite metrics. The company is posting a 1.35 per share on free cash flow. That equals a yield of 4.79%, and their price to free cash flow is 20.87. ROIC, which helps us measure the returns on invested capital, which is a kind of a great substitute for a moat, is 15.08, which is not too bad. And their weighted average cost of capital, which is a great comparison to those returns on invested capital, is 6.83%. And the credit rating versus via Moody's, which is one of my favorite websites to use to help us get in a sense of what kind of credit rating the company has, is a BA1, which is speculative, and it's not that great of a rating, but it's not horrible either. So that's kind of what's going on with the company.
You threw a ton of numbers at us, so maybe laser in on a couple.
Okay. I think a couple things that I would look at, first of all, is obviously the revenue. So the company is still down from prior to COVID, which is a little bit to be expected. You can see there on the chart that they're still down, but they are trending back up. This last quarter was up big time, and the company is guiding towards returning to pre-COVID levels here this coming next quarter, as well as going into the rest of the year. That includes earnings as well as revenues. So the company is optimistic that they're going to return to the steady state that they're on prior to COVID. So that's a good sign. With the return to, I guess, normalcy, if we want to call it that, I think the company is optimistic that the things will start to return. Another thing that I thought was kind of intriguing was the return on invested capital was actually quite good. I'll be honest with you, when I first started looking at the company, I thought maybe this isn't going to be so hot, but the company is really starting to, they continue to grow. Company's been around since 1853, so it's not exactly a new up and coming tech company, but I think one of the things that is optimistic about the company is the durability of the product that they produce, as well as the attractiveness. They've been able to, I guess, maintain a great company for all these years. It's pretty outstanding, and they continue to increase their returns on invested capital, which for lay people helps us understand that the more that they can reinvest in the company, the more they can help grow. And the higher the number is, the more efficient that is. And when you compare that to what's called a WACC, or the weighted average cost of capital, that basically means the cost of doing business for Levi. And the lower that number is, or the bigger the gap is between an ROIC and a WACC, the better it is, because that means that the company is able to grow at a faster pace than it costs them to grow. So for example, for every 15, so the 15%, which means that they earn 15 cents in every dollar that they invest. And the higher that number is, the better. And typically great companies with higher ROICs like Apple and Microsoft, they produce ROICs in the 20 to 30 to 40% range. And for a company which you would think is boring like Levi, to produce those kinds of numbers is pretty amazing.
What would you say for somebody who's looking into Levi as possibly an investment, what they should focus on? Like, what would you look for if you're looking for a retail?
What would I look for? I think, well, I guess there's a couple things that probably that stand out. The first thing I guess I would look for would be what kinds of returns on invested capital can the company generate, which we've already kind of touched on. The other thing I would look at would be any kind of trends that may help shed some light on whether the company can continue to grow and to improve, and also any sort of pricing power that the company may have, because they sell a brand and a product that is well known throughout the world. They have a little bit of pricing power, but they also have to be, I guess, cognizant of any sort of fashion trends that may go on. And I will be the first to admit that is way out of my league. So that is not something that I would be super conscious of. But thinking about what the company has been able to do through all these years and maintain a relevance, I think is an impressive feat. So I think I would look at revenue trends, what kinds of opportunities they may have to expand, not only here in the United States, but other markets that they're trying to expand into, and how effective they may be in those expansions. And then what kinds of, I guess, internal financials the company is able to maintain, keeping the debt level low that they can continue to try to grow organically, and just kind of see kind of where that goes and where it takes us.